Hello and welcome to the presentation on net present value and other investment criteria. In this chapter, we'll be discussing key concepts and skills pertaining to understanding the capital budgeting techniques or the investment decision criteria. Specifically, you should be able to compute the payback and the discounted payback and understand their shortcomings. Understand accounting rates of return and their shortcomings, be able to compute internal rate of return, popularly called as IRR, and understand its strengths and weaknesses. You should be able to compute the net present value and understand why it is the best decision criteria. Be able to compute the profitability index and understand its relation to net present value. So in all, we'll be discussing around 6 investment decision criteria, which as a finance manager, you need to evaluate the projects. So when we talk about evaluating projects, the good decision criteria is we need to ask ourselves the following questions. Pertaining to the evaluation of capital budgeting decision rules. Does the decision rule adjust for the time value of money? Because we are talking about decision for the future cash flows, so it is imperative that we need to know how you are going to adjust the time value of money. Also, because we are talking about future and future is uncertainty, so risk is prevalent there. So does the decision rule adjust for risk is the second most important question you need to ask while doing the evaluation of capital budgeting decisions. Does the decision rule provide information on whether we are creating value for the firm? Because when we say a business is there to create value for the shareholders' wealth creation. Okay, so therefore, when we make capital budgeting decisions, we make sure that these 3 questions are taken care in terms of taking consideration while making a investment decision or capital budgeting decision. So now let's talk about the capital budgeting process. We say that capital budgeting consists of 5 distinct and interrelated steps. The first step is the proposal generation, where managers at all levels in a business make proposals for new investment projects that are reviewed by finance personnel. Proposals that require large outlays receive greater scrutiny than less costly ones. The second step, once you know that you need to have a proposal for investment projects, so these proposal needs to be formally reviewed by the finance manager by seeing or assessing their merits in terms of whether it is going to add value to the shareholders' wealth. Then the third is decision making. Firms typically delegate capital expenditure decisions on the basis of dollar limits. Generally, the board of directors or a team of very senior executives must authorize expenditures beyond a certain amount. Often, plant managers have the authority to make decisions necessary to keep the production line moving. And then once firms make these capital expenditure decisions, because these are irreversible decisions, once you commit your huge outlay of funds into these decisions, the benefits are reaped in the future. Like for example, you are talking about automating your plant. So this automation requires getting robotic technology into your plants. So this becomes a huge outlay of investment to be made, and that's why we call it as capital expenditure decisions are irreversible. So therefore, care should be taken by the managers, and that's why it requires authorization for the expenditures beyond a certain amount of time, and usually senior managers may also need to take sometimes the board's approval. So talking about the step 4 is the implementation, that is following the approval. Once firms make expenditures and implement these projects. But keep in mind that expenditures for large project often occurs in phases, so you can monitor and follow up and compare actual costs and benefits to the projections that originally used to justify making the investment. So as a part of follow-up, as the step 5, managers may take actions to expand, contract, or shut down investments when actual outcomes differ from projected ones. So the capital budgeting process is a 5-step process. It is not as proceeding in a process way, but it could be going up and down depending on how you tackle the situations. Now, talking about the major focus of this chapter is understanding the capital budgeting techniques or investment decision-making criteria. So usually in the hands of the managers, they have what we call it as the process of evaluating and selecting long-term investments that contribute to the firm's goals of maximizing owners' wealth. So you have two basic criteria or investment criteria or capital budgeting techniques. The traditional technique, which doesn't take into consideration the time value of money, is you have two approaches: payback period, average accounting return. The second category, the modern or sophisticated or time-adjusted techniques, are net present value, profitability index, internal rate of return, and the discounted payback. Keep in mind that the motives for capital expenditure is nothing but, as we said, capital expenditure and operating expenditure needs to be clear-cut difference. So since we are talking about capital budgeting techniques, these are long-term investment decisions. So they are also called as capital expenditure. So in other words, I can say that an outlay of funds by the firm that the firm expects to produce benefits over a period of time greater than 1 year. In the case of operating expenditure, an outlay of funds by the firm resulting in benefits received within a year. Okay. So these capital budgeting process, which consists of 5 distinct but interrelated steps, needs to be taken in terms of step 2, that is the review and analysis. So as part of the step 2, you can use these two techniques, that is the traditional and the modern and time adjusted techniques. So let's talk about these techniques by way of a practical example of a company, Bennett Company, which is a medium-sized metal fabricator that is currently contemplating 2 projects with conventional cash flow patterns. So they have 2 projects. Project A requires an initial investment of $420,000, whereas the project B requires an initial investment of $450,000. So these projected cash flows appear in the table as this. So you have a useful life of this 2 projects, which is 5 years. But as you can see, their cash flows are different. So if we put this in the timeline, it is something like this. So as you can notice, the project A is having 140,000 each year, the same cash flows. So we call them as annuities. So if you have an annuity, you have a different kind of treatment to compute these techniques. Anyhow, we will show you when we take each one of these techniques. So you have project A having a $420,000, whereas project B, the initial outlay is $450,000. So let's talk about the first technique or the investment criteria, that is the payback period. Okay. So keep in mind that the payback period is nothing but the time it takes an investment to generate cash inflows sufficient to recoup the initial outlay required to make the investment decision. Okay. So that means in other words, we can say that the payback period is the time it takes to get back your initial investment which you have committed in the project. So in order to make a decision, the decision criteria is if the payback period is less than the maximum acceptable payback period, so we are going to accept the project. If the payback period is greater than the maximum acceptable payback period, then we are going to reject the project. So in other words, you need to have a acceptable payback period assigned. So let's say let's take the example of the Bennett company data and then compute the payback period. So let's do this now. So you have the project A and project B cash flows given to you. So we can calculate the payback period using this data. So as we said, the project A, the cash flows are repeating. So in this situation, project A is an annuity. So the payback period is simply calculated as we can call it using a formula. Payback period for project A is simply initial investment divided by annual cash flows. Initial investment divided by constant annual cash flows. Okay. So how much is your initial investment is 420,000 divided by 140,000. So that gives me 14,342. So 3 years. Okay. So the payback period for project A is straightforward using the formula initial investment by annual cash flows. The annual cash flows were 140. So we get 3 years as the project payback period. Then let's calculate for project B. In order to calculate project B, we need to go into what we call it as cumulative cash flows. So let me just calculate the cumulative cash flows. Cumulative cash flows. So you have 280,000. Okay, 280,000. This is the first year. Then 280 plus 120. Okay, so 280 plus 120. So that becomes 400,000. Okay, then you have 400 plus 100, that gives me 500. 500 plus 100 gives me 600, and then finally 700,000. So where we are able to recoup 450,000, I am receiving it in between 2 and 3 years. So this is year 1, 2, 3, 4 and 5. Okay. So I am going to receive 450,000 between 2 and 3. So I can say payback period for project B is 2 years plus a fraction of third year, right? Fraction of third year. So how much we are going to receive in the third year? So I can calculate something like this. So 2 plus fraction of third year is I have to receive 450,000. I have received how much? 400. So cost is 450 minus how much we have received until year 2. Year 2 is 400,000. Okay, divided by how much I can receive in the third year. The third year the cash flow is 100,000. So 450 minus so that becomes if I solve this, let me solve this in the calculator. So 50 by 100, that becomes 0.5. 0.5. So that brings to 2.5 years. Okay. So the payback period for project A is 3 years, and for project B it is 2.5 years. Okay. So this is how you are going to compute the payback period. So payback period, if the cash flows are constant, you can use this formula. If they are not constant, they are variable in nature, then you can use the cumulative cash flows and then see until what point you are receiving the cash flows. So since it is not straightforward, we are receiving between 2 and 3. So therefore the payback period for project B is 2 years plus a fraction of the third year. In the third year we have to receive how much? Because the cost is 450. So 450 minus, we have received until 4 lakhs. So we have to receive 50,000 in the third year. So in the third year we are receiving 100,000. So 50 divided by 100 gives me 0.5. So it is 2 plus 0.5, that is 2.5 years. So now the question is how you are going to make a decision which project is good. So naturally the lesser the time period it takes, that project is the best. But if Bennett's maximum acceptable payback period were 2.75 years, then project A would be rejected and project B would be accepted. If the maximum acceptable payback period were 2.25 years, then both projects would be rejected. If projects were being ranked, then B would be preferred over A because it has a shorter payback period. Note, however, that no matter what payback period Bennett requires, it is unclear from payback analysis which investment will do the most to increase the shareholder wealth. All we can say is that project B recoups the initial investment more rapidly than project A, but whether they are going to increase the shareholders' wealth, we are not sure. If we see the practical point of view, as a matter of fact, a survey was conducted in India in 2017, found that two-thirds of those firms almost always conducted payback analysis when they made major investment decisions. And these are similar to results found in US firms. Small companies in India were more likely than large firms to use the payback approach. Even though the payback is having all its flaws, but still there is a widespread use around the world. Okay. So coming back to our questions, the decision criteria test, where does the payback fit? Is payback a good method to rely on as it is popularly and widespread use around the world? Let's see the decision criteria test. So the first question is, does the payback rule account for the time value of money? No. It's clear cut. It's not taking any importance to the future cash flows. So the answer is no. Does the payback rule account for the risk of the cash flows? Again, no questions are being asked about the risk of the cash flows or riskiness of the cash flows. Does the payback rule provide an indication about the increase in value? We are not sure, right? We are not sure. So I can say that it's no. Should we consider the payback rule for our primary decision rule? Definitely not, because of all the flaws in it. Okay. The payback period can be interpreted as a naive form of discounting if we consider the class of investments with level cash flows over arbitrary long lives. In order to remove the time value of money, many of the people, they discount the cash flows and they use another version of the payback period. That is what we call it as the discounted payback period. We will take that into consideration, but let's talk about what are the advantages and disadvantages of the payback method. Advantages: it's easy to understand. It adjusts for uncertainty of later cash flows, biases toward liquidity. Okay, so you are talking about getting back your money quickly. Disadvantages: it ignores the time value of money, requires an arbitrary cutoff point because you are not sure which is the uh, target payback period which you should rely on. Okay, so these are all arbitrary. And it ignores the cash flow beyond the cutoff date. Suppose you are going to receive more cash flows at the end of the years, those are not going to be taken into consideration. So that's why it ignores the cash flow beyond the cutoff date. And it is biased against the long-term projects such as research and development and new projects. Now let's talk about another traditional technique. We call it as the average accounting return. In fact, it's a bookish one, and you can say that if payback period is the bad technique, then accounting or average accounting rate of return is the worst technique. So there are many different definitions for average accounting return. The one used in the book is the average net income divided by average book value. Note that the average book value depends on how the asset is depreciation, and you need to have a target cutoff rate. So the decision rule is you are going to accept the project if the average accounting rate is greater than the present rate. Now if we move on, because this this requires the accounting values. We are not going to use it for the Bennett company because the Bennett company is having the cash flows given to us. So the cash flows are different than the net income, which is to be used in the average accounting return. So if any problem comes, simply you can use this formula to compute the accounting average return. Okay. Now let's talk about the decision criteria test. The 4 questions we will talk and implement on this. Does the AAR rule account for the time value of money? No. In fact, it doesn't even take the cash flows into consideration. Does the AAR rule account for the risk of the cash flows? No. Does the AAR rule provide an indication about the increase in value? We cannot rely on this because it is based on the accounting data. Okay, that is a static data, but the cash flows are the dynamic data which we need to take in the investment decision criteria. And should we consider the AAR rule for our primary decision rule? No, because of its flaws, and it is more worse than the payback period, we will not take it into consideration as our primary decision rule while making investment criteria decision making or the capital expenditures. Now let's talk about the advantages and disadvantages of this average accounting return. Mm, it's easy to calculate. Needed information usually will be available because you are using simply the as it is the historical financial statements or the data. You are not doing any calculations for the cash flows. Okay, so you are directly taking the net income and the book value. So it's very simpler to calculate than the payback period. The disadvantages are plenty of it. It's not a true rate of return, and it doesn't have time value of money into consideration. So the time value of money is ignored, and it uses an arbitrary benchmark cutoff rate, and it is based on the accounting net income and book values, not cash flows and the market values. So let's move quickly to the discounted payback period, which overcomes the time-adjusted demerit of the payback period. So let's see the discounted payback period. So the discounted payback period is similar to that, but we compute first the present value of each of the cash flows and then determine how long it takes to pay back on a discounted basis. So you compare to a specified required period. Again, this is a arbitrary one, and the decision rule is the same as we discussed in the payback period. That is, accept the project if it pays back on a discounted basis within the specified time. So let me just show you this using Microsoft Excel. We can calculate the discount payback for the Bennett company data. Okay. Now let's compute the discounted cash flow for the Bennett company data. So you have the two projects. So the first thing which we are going to do is computing the discounted cash flow, and then we use the cumulative discounted cash flow, and then finally compute the value. Okay, so the present value factor we can find by using 1 divided by 1 plus k. So 1 plus k. K is the discount rate 10%. Okay, to the power of the first year. Okay, each year. Okay, and since this I am going to make it fixed, so I put the dollar signs, fix the E5 for both the column and the row. Okay, so I get 0.909. I just take 3 digits, so just remove 3 digits and then then copy down the formula by Control D. So you have the present value factor table, right? The value of $1 in 0 year is 1, and the first year the value becomes 0.909. The farther it is from the future, it is lesser the value. Okay, that's what we have seen. So now calculating the discounted cash flow is simply the operating cash flow for project A times the present value factor. So you get the project A cash flows, right? Control D. Then similarly, you can get the cumulative discounted cash flow is equal to this plus, okay, the first year is as it is. Okay, from second year we say this the previous year plus the current year. So this becomes my cumulative cash flows. I can just Control D to get the cumulative cash flows. So what do you observe? So for project B also we can do the same thing. Cash flows for project B times the present value factor will give me the project B discounted cash flows. Control D to get all the discounted cash flows is equal to this previous plus the current discounted cash flow will give me the cumulative cash flow, and then control D. So what do you observe? You observe that project A is 420 and you are receiving in the third year. It's taking 3+ years, right? So you are going to receive in the fourth year all the amount, right? And in the case of project B also the same. So I can say that 3 years. So the discounted payback period, okay, I can say that discounted payback period is what is equal to for project A it is 3 years plus a fraction of year. So I just put is equal to 3 years plus a fraction of a year. A fraction of a year we have done in the case of the uh, payback period earlier. How we did, we have taken the cost of the project, okay, minus how much is the money which we have received until the second year, right? And so I can say this in bracket and then divided by amount of money I am going to receive in the fourth year. In the fourth year I am going to receive is, I think we have done something wrong. It is the third year plus fraction of a fourth year. So I have to take the fraction of the fourth year. This minus the fourth year. Fourth year means this. So I have to take this, right? And then divided by the fourth year cash flow which I'm going to receive. So this gives me 3.75 as my value. Okay, we'll put this in number. Let it be near to this. So 3.75 years is my payback period for project A. So similarly, what is the discounted payback period for project B? We can simply take is equal to, it is also taking 3 years plus, so 3 years plus a fraction of a year, right? A fraction of a year means the project cost minus in the third year how much I have received, right? Divided by how much I am going to receive from the fourth year cash flow. Okay, so this is giving me 3.31 as the time period. Okay, so the discounted payback period for project A is 3.75 and for project B is 3.31. So let's go. Okay, now coming back to the PowerPoint. So we can say that assume we will accept the project if it pays back on a discounted basis in 3 years. So based on the calculations in the Excel template, we discovered that the projects are having more than 3 years. So do we accept or reject the project? So definitely we will not accept the project. We will reject the project. Why? Because it doesn't pay back on a discounted basis within the required 3-year period, because both projects are taking more than 3 years. So let's see the decision criteria test, the 4 questions. Okay. Does the discounted payback rule account for the time value of money? Yes. The answer is yes. Does the discounted payback rule account for the risk of the cash flows? Yes. Okay, because we are assuming that the cost of capital is taking care of the risk part also. Does the discounted payback rule provide an indication about the increase in value? No. The answer to the third question is no, because of the arbitrary cutoff. Since that rule does not indicate whether or not we are creating value for the firm, it should not be the primary decision rule. So we will not be taking it as a decision rule. So we have till now we have talked about the three decision criteria: the payback period, the average accounting return, and the discounted payback. And we have said the final answer to the fourth question as we will not take them as our primary decision rule. The reason for the discounted payback we'll see based on its advantages and disadvantages. So let's see the advantages and disadvantages of the discounted payback. The advantages is it has overcome the payback demerit of not using the time value of money. So this includes the time value of money. Still, it is easy to understand and does not accept negative estimated NPV investments when all future cash flows are positive. Again, it is biased towards liquidity. The disadvantages may reject positive NPV investments. Reason could be because of the ignorance of the cash flow beyond the cutoff point, and also there is the disadvantage of it requires an arbitrary cutoff point, and it is biased against long-term projects such as R&D and new products. Okay, so taking these the three methods, now we move on to the most reliable, most theoretically strong, conceptually strong method of investment evaluation, which we call it as the net present value. So a capital budgeting technique that measures an investment's value by calculating the present value of its cash inflows and outflows. It's similar to your discounted cash flow, but in the case of the discounted cash flows, we are computing the time it takes to recap the initial cash flows, initial investment. In this case, we subtract from the net present value, from the present value of the cash flows, we subtract the initial investment to get the net present value. Keep in mind that not every investment opportunity has this kind of standard cash flow pattern. Sometimes firms receive money upfront and have to pay out cash in later years. Other times, a project requires several years of cash outflows before inflows begins. Okay. Therefore, a more general equation for an investment's NPV is taken into consideration. But taking this NPV equation, if you apply this in the Excel, it will give you a misleading answer, because here we are using the time value starting from 0 to n years. So if you take 0 also under consideration, the Excel will give a wrong answer. Okay, so I will show you when we take up the Excel model there. Okay, now moving on to the accept reject criteria, the decision criteria. So we are going to accept the project if the NPV is greater than 0. Okay, sometimes you may also accept if the NPV is also equal to 0, but you are going to reject the project if the NPV is less than 0, because it is not going to add value to the shareholders' wealth. So let's illustrate the NPV computation using the Bennett Company's data. Okay, so we can use this through the Microsoft Excel. Okay, first I will show you the Microsoft Excel version, and then we move on to the financial calculator version. Okay, so let's go to the Microsoft Excel version. No, not this one. We move on to the Microsoft Excel. Go to the PowerPoint now. Okay, now that we are back into the Excel sheet, in the previous slide, we have computed the cumulative discounted cash flow and the discounted payback period for project A and project B. Let's calculate NPV for project A and project B. What we do is we bring the cash flows here, okay, because we want, or we can use it here, no problem, okay. So NPV I can use using the NPV function is equal to NPV, okay. It is saying me rate. What is my rate? Rate is the discount rate, the 10%, comma, the values, okay. So you are going to take all these values. Make sure that you start from first year, okay. Take all the values and then minus your project cash flow, okay, your initial investment. So this will give me the NPV for project A. So simply if I copy to the next cell, Control R, I will get my project, but make sure that this is correct. Okay. You see this is shifting here, so bring it here. So all are okay. So I have NPV for project B is 109 and project A is 110. Okay, so we don't have to do much in terms of computing the NPV because we have a inbuilt function in the Microsoft Excel, that is NPV function. So using the NPV function, it is very simple. But what happens is if you use the general formula includes zero and all these cash flows. Okay, so if I copy it here and then bring my 420, 450, right? And these are negative cash flows. Initial investments are shown by negative, so you can put a negative to this. And if you use the general formula, then you see the NPV will be wrong. Okay, I'll show you this is the right approach. This is right way to do this. Okay, there is a wrong way because many experts they make this mistake because they calculate NPV using they will use the formula NPV, okay, NPV formula, function formula. They take the rate properly, and then when it comes to the values, they take from 0 to the fifth year because of the general equation which we said in the PowerPoint. Okay, so they may take all this from 0 to 5 because the summation sign starts from time 0 to ends at the terminal year of the project. So many they make this mistake. So you see the answer will be different. You see, you get $100 as my NPV, but the correct approach is this is the correct approach. You can say correct or right. Correct approach. Okay. So this is a big mistake being done by the practitioners sometimes, because when they calculate NPV, they use the general formula, and when they use the general formula starts from 0 year, so they take all the cash flows as part of the NPV function. So that becomes a wrong computation. Okay, so this you need to keep in mind. So now move on to the interpretation of this in the PowerPoint. Let's go to the PowerPoint. Okay, coming back to the PowerPoint, so we can say that the projects from the Excel sheet we got is project A as 110 and project B as 109. So we can say that both projects are acceptable because the net present value was each is greater than $0. But if we want to rank the two projects, then we would have ranked project A is superior. Why? Because of the more dollar value than the project B's 109. Okay, so we would say that project A would be considered superior to project B because its net present value is higher than that of B. Now we move on to the how to compute using financial calculator. So if you have a financial calculator, we can use the cash flow register and the pre-program NPV function in the financial calculator to perform the NPV function. So you will get something like this. Okay, and then if you take for project B, similar keystrokes will give me the NPV project. Okay, so let me just show you by the financial calculator using our mobile app store. Okay, you have the financial calculator here, which you can download from the app store. So the keys which we are going to use is the cash flow. Okay, the cash flow key. So let's use this cash flow key. So what is the cash flow for the project? We have 400. Let's do for project 1, that is project A. You have 420,000, right? Make sure that this is the inflow, and inflow is represented by a minus sign. You can use this keyboard plus minus key to represent it as minus, and then see what it says. It says enter. Okay, so enter. Now this is enter. Then it says go to the arrow, go down. Okay, so once you move down, you know that these cash flows are annuity. How much it is? 140,000, right? So since these are annuity, we enter this. Okay, and then how many years these are repeating? These cash flows are repeating for 5 years, so I just say 5 years. Okay, so once you enter 5, why? Because this is indicating the frequency of the annuity cash flows. Okay, so since these 140,000 is repeating for 5 years, so we need to write F01 equal to 5, then enter. So once you enter, this 5 has been fixed for F01. After entering the discount rate, so let's enter the discount rate. That is, how much is the discount rate for the NPV? So we want to know what is the NPV. So it asks, the moment I press NPV, it is asking me the discount rate. So how much is my discount rate? We said let's assume it as 10%. So write 10, don't write 0.10. Okay, write 10 and then press enter and then go down. Okay, then it says compute. Okay, so press the compute button. So once you press the compute button, you will get the answer. So since I have put 4 decimal digits, so that's why it's not coming 0.15. Okay, so in the slide we showed you as 0.15. Now once you have this, we move on to do the next project. That is, you have the cash flows. Okay, so I can make the changes here. No, first so once you have done this, now do the project B. So what is project B? In project B, I need the cash flows to be changed. Okay, So one way is you can go for second, okay, reset. So it says, do you want to reset the calculator? Yes. Okay, now check, the cash flow is not there. So now we can feed the project B version. So what is project B? In project B we have seen the cash flow in the current year, that is the cash outflow of 450,000. Okay, write 450,000, and since you have to put minus sign, you press this key, plus minus, okay, and then press enter, and then go down by the down arrow, and then what we have to feed, the first year it is 280,000, right, 280,000, then enter. Then in the second year again the cash flow is different, it's not the same, so I don't put anything this. So because this is talking about the frequency of the cash flow going, so since we are receiving 280,000 for one time, so we keep the default one as 1. Then we move further down by the down arrow, okay, so you get C02. Then feed the next cash flow for the second year, that is 120,000, enter, and then go down arrow. So since this is also having the frequency of 1, that means we are receiving 120,000 for only one period, that is year 2, so we just keep as it is. Then we move down, okay. So the third year cash flow, the third year cash flow is 100,000, right, but make sure that these are coming for 3 years. So I need to put the frequency not as 1, because this is going to repeat for 3 years. I feed 3 here and then enter. So once I do this feeding, okay, press the NPV button to compute the NPV. So it is asking how much is my cost of capital or the discount rate. So the discount rate was assumed as 10, enter, and then press the down arrow and then compute. So it says compute, so press compute and you get 109,243.966. So in the slide I showed it as 109,244. Okay, so you can make 244. So this is how you calculate the using the financial calculator. It's so straightforward, so simple. So I'm not showing you, I'm not encouraging you to use the what we call it as the formula method or the table method. We will use the financial calculator method because it's very straightforward and simple and easy. Okay, now coming back to the PowerPoint. So we have computed and we got the same values which we received for NPV for project A and B from the financial calculator, also the same. Okay. So if we plot this in the time value or the timeline, it will be something like this. Project A and project B. Okay. So since project A is a annuity, we can directly discount the entire annuity and get the final answer with a quick formula method. Okay, but in this case you need to discount each of these cash flows because they are different. But in the financial calculator we have treated them as one same for the last 3 years, right? So the frequency of the year was taken as 3 for this year, and for them the frequency was taken as the 5. Okay, so thereby the financial calculator and the Excel sheet and the table and formula value method will give me the same answer which we have. So since both are positive, so we are going to accept this. Now let's see the litmus test, the 4 questions, the decision criteria test for the NPV. So does the NPV rule account for the time value of money? The answer is yes. Yes. Does the NPV rule account for the risk of the cash flows? Yes. Does the NPV rule provide an indication about the increase in value? Yes, because the positive NPV value reflects that the wealth, the shareholders' wealth will be maximized to that dollar amount of value of the NPV. Okay. So should we consider the NPV rule for our primary decision rule? Yes, because it is very strong, conceptually strong. It should be considered for a basic or primary decision rule. Okay. So that means the theoretical and the conceptual view is that payback period is a bad technique. The average accounting return is a worse technique. Discounted payback period is overcoming the problems of the payback period, but still NPV is a clear winner. Okay. There is another version of NPV wherein instead of subtracting, we divide the initial cash flow. So we call it as the profitability index or the benefit cost ratio. So let's see the next important criteria of investment decision making is the profitability index or the benefit cost ratio. Okay. So for a project that has an initial cash outflow followed by cash inflows, the profitability index is simply equal to the present value of cash inflows divided by the absolute value of the initial cash outflows. In the case of NPV, we were subtracting. Here we are dividing. Okay. So what is the decision criteria then? A profitability index greater than 1 implies that the present value of cash inflows is greater than the absolute value of the initial cash outflow. So a profitability index greater than 1 corresponds to a net present value greater than 0. In other words, the NPV and PI methods will always come to the same conclusion regarding whether a particular investment is worth doing or not. Okay. So if we go to the Bennett data, Bennett investment options, if we use the profitability index, so simply take the present value and divide by the cash flows, you will get a PI of 1.26 and 1.24, the same thing which we got. So as per the NPV, we said project A is better than project B in terms of giving more for this. So same way, not surprisingly, we said both projects are accepted because PI is greater than 1. Furthermore, in this particular case, the NPV rule and the PI both indicate that project A is preferred over project B. It is not always true that the NPV and PI methods will rank projects in exactly the same order. Different rankings can occur when alternative projects require initial outlays that have very different magnitudes. So let's summarize the profitability index. Profitability index measures the benefit per unit cost based on time value of money. So we can say that a profitability index of 1.1 implies that for every $1 of investment, we are creating an additional $0.1 in value. So this measure can be very useful in situations in which we have limited capital. So finally, we discuss the advantages and disadvantages of the profitability index. So the main advantage of the profitability index is it's closely related to the NPV and generally leading to the identical decisions unless and until there are some magnitude difference in the cash flows. And it is easy to understand and communicate and may be useful when available investment funds are limited. The disadvantage is may lead to incorrect decisions and comparisons of mutually exclusive investments. So therefore, even though it is similar to your or identical to the NPV, but NPV is a clear winner because in the case of a mutually exclusive investments, NPV is the best technique of investment decision making. Okay. Now the final technique which we'll be discussing is the internal rate of return. This is the sixth in line of your tools. This is what we call it as the IRR. So in simple terms, we can say that IRR is that point where NPV is 0. So that means at what rate you are getting NPV as 0. So we say that particular rate is what we call it as the internal rate of return. Okay. So the criteria for decision making is if the IRR is greater than the cost of capital, we are going to accept the project. And if it is less than the cost of capital, we will reject the IRR. You can use the financial calculator and you can do the NPV and IRR together as I showed you. So let's talk about how we can use the financial calculator and do this. So if you have the formula method, then it becomes a very cumbersome because what happens is if you use the Bennett company data and use the formula method, it will be something like this. So it is you are writing 1 by IRR because the discount rate is not known, and this is what is IRR. So the rate of discount at which your NPV is becoming 0 is what we call it as IRR. So you need to use a trial and error approach to compute this, and it will become a very cumbersome. Okay, so therefore usually we prefer to use a financial calculator. So using the financial calculator is a straightforward thing. Simply you are going to take the IRR button and you are going to compute. So if you compute this using the financial calculator, let me demonstrate you how we do this. Okay, so we have calculated the NPV for project B. So I will show you the IRRs. You see beside the NPV button we have the IRR button. So we can simply click IRR and then say compute. It says compute and you see khalas, you get the answer within less than a fraction of a second. Okay, so 21.65%. So similarly, if you do for the previous one, project A, you will get the same thing. So simply what you are going to do, press IRR and that's it. Okay. Okay, so when we computed the IRR using the financial calculator, we got IRR for A as 19.9 and IRR for B was 21.7, which is greater than the cost of capital. So both projects will be accepted. But if we compare the two projects IRRs, Bennett's managers rank project B over project A because project B delivers a higher IRR over A. Okay. So if these projects are mutually exclusive, meaning that Bennett can choose one project or the other, but not both. Mutually exclusive means you have to take only one project out of the two. So the IRR decision technique would recommend project B, and that is what is going to be shown in the terms of the time scale. Okay. So you get IRR 19.9, and if you substitute it as the cost of capital or the discount factor, your NPV will be 0. Okay. Similarly for this. So now finally we talk about NPV and IRR techniques. Now we try to compare which is good, because what happens is IRR is preferred over NPV by the practitioners. Despite NPV is a clear winner, IRR is preferred. So let's compare NPV and IRR techniques. So in order to compare NPV and IRR techniques, we can do what we call it as NPV profiles. That is, we put a graph with the different discount rates projected, and each is talking about at different points of discount rates what is the NPV. So if you plot all this, that gives us the net present value profiles. So let's apply this to the Bennett company's two projects, A and B. So in order to do this, we require the coordinates. Okay, so you can get the coordinates very easily if we assume a zero discount rate. Okay, for both the projects, and then if we summarize them in this order, you will find that at 0% it is nothing but project A and project B, the values we get, and at 10% is the NPV, and at 19.9 and 21.7 is the IRR. So if we plot this in the graph, that gives us the NPV profiles. So if we show it on the graph here, it is something like this. So the 10.7% is what we call it as the crossover rate. So beyond this crossover rate, things will be indifferent, right? So here I will be like, say, if we talk about these two projects, the project A is a winner over project B when the crossover rate, the discount rate is less than 10.7. If the discount rate is more than 10.7, that is the crossover rate, then IRR for project this is project B, right? Red is project B. Project B is preferred over project A. Okay, so this is the indifference based on the crossover rate. So that's what is the conflicting rank sometimes. So if we talk about NPV and IRR, will generally give us the same decision, but there are some exceptions. So why these exceptions are there, let's see that. Exceptions could be because of non-conventional cash flows. That means cash flow signs change more than once, or it is a mutually exclusive project. That means you need to decide any one of the project. So if the crossover rate is changing, we have seen that there are indifferent versions of selecting the project. Okay, so now let's talk about IRR and non-conventional cash flows. That means if cash flow signs change, what is the problem which IRR has? So when the cash flows change sign more than once, there is more than one IRR. So what happens is, if your non-conventional cash flows are having more than two sign changes, then you will get two IRRs. Okay, so that is what is the problem. So when you solve for an IRR, you are solving for the root of an equation, and when you cross the x-axis more than once, there will be more than one return that solves the equation. So if you have more than one IRR, definitely which one you are going to rely is a big question. So let's understand this with a simple example. So a good introduction to mutually exclusive projects and non-conventional cash flows can be shown using this simple example. So if you have, suppose an investment will cost $90,000 initially and will generate the following cash flows. So note that I have the initial investment, this is a negative cash flow, and then in year 3 I have another negative cash flow. So you have two cash flows. Then what will happen is you may get a multiple IRR. So if we plot this and compute this returns, you will find that it is something like this. So that means we are getting two IRRs, one at 10.11 where we get NPV as 0, then again at 42.66% you get NPV 0. So will you accept the project if the required return is between 10 and 11%? So that will be a problem. Okay. The NPV is positive at required return of 15%, so you should accept. If you use the financial calculator, you will get an IRR of 10.11%, which would tell you to reject. So you need to recognize that there are non-conventional cash flows and look at the NPV profile. Okay. So now let's talk about mutually exclusive projects. If you have a mutually exclusive project, then what will be the problem with IRR? So let's see IRR and mutually exclusive projects. So as you know, mutually exclusive project means if you choose one, you can't choose the other. So you can choose to attend graduate school at either Harvard or Stanford, but not both, right? So intuitively, you would use the following decision rule. NPV, choose the project with the higher NPV. IRR, choose the project with the higher IRR. Okay. So this is, let's see the example of a mutually exclusive project. So if you have two projects and they are mutually exclusive with 500 and 400 as the initial investment, note that the cash flows in the initial year, first year, is the same. In the second year, project A is giving me more than project B cash flows, right? So IRR is 19.43% and 22.17%. NPV is 64 and 70. So if the required return for both projects is 10%, which project should you accept and why? So which project should you accept and why? Yes, think. So we can say that as long as we do not have limited capital, we should choose project A. But suppose if we talk about suppose the point is that we do not have limited capital, so we can invest in both A and B. Okay, so if you talk about profiling these two together, then you will find that there is a crossover rate. See this? So the crossover point is this. So this project, out of these two projects, we are going to accept the red one, that is project A, if the discount rate is less than the crossover rate. If the discount rate is more than the crossover rate, then you will prefer project B over project A. Okay, so IRR is giving me a conflicting decision. So if you see the previous slide, in this case we said you are going to choose a project which is having a higher IRR, and we are going to choose a project with a higher NPV. So NPV is telling accept project A, IRR is telling me to accept project B. So I may not rely on IRR. Why? Because of the problems in IRR. So I will take into consideration what NPV is guiding me. Okay. So if we see the points, NPV directly measures the increase in value to the firm. Whenever there is a conflict between NPV and another decision rule, you should always use NPV. IRR is unreliable in the following situations, that is non-conventional cash flows and mutually exclusive projects. Okay, so in order to rectify the problems in IRR, we can use a modified IRR. there is also a function in Excel which you can use modified IRR. So what is modified IRR? You calculate the net present value of all cash outflows using the borrowing rate. Then you calculate the net future value of all cash inflows using the investing rate. Then find the rate of return that equates these values. Benefits. So you will have a single answer and specific rates for borrowing and reinvestment. So let's talk about what is acceptable in practice. What is the practitioners still believing? So if you see that, we should consider several investment criteria when making decisions. NPV and IRR are the most commonly used primary investment criteria by the practitioners. Payback is also a very popular because of the rule of thumb, and it's a very easy technique. So it can be used by many of the practitioners commonly in terms of evaluating secondary investment decisions. Okay. So then finally we close our discussion on this chapter by summarizing each of these points. So net present value, keep in mind that it's talking about the difference between market value and cost. It takes into consideration the project if the NPV is positive, and there is no serious problem in net present value, and it's a preferred decision criterion, and it is conceptually strong without any demerits. Pertaining to the internal rate of return, the discount rate that makes NPV is equal to 0. Take the project if the IRR is greater than the required return. Same decision as NPV with conventional cash flows, but IRR is unreliable with non-conventional cash flows or mutually exclusive projects. Profitability index, or what we call it as the benefit cost ratio, is similar to your NPV. So you take investment if profitability index is greater than 1, but cannot be used to rank mutually exclusive projects. Again, NPV is a clear winner when there is a mutually exclusive project. May be used to rank projects in the presence of capital rationing, but suppose there is limited funds, then profitability index can be used to rank projects. Okay. Then talking about the next two techniques, that is the payback period and the discounted payback period. Payback period, length of time until initial investment is recovered. Take the project if it pays back within some specified period. Doesn't account for time value of money, and there is an arbitrary cutoff period. So we say payback period is a bad technique. To overcome the demerits in the payback period in terms of the time value of money, we use the discounted payback period, which is similar, but we use the length of time until initial investment is recovered on a discounted basis. Take the project if it pays back in some specified period. There is again the demerit of an arbitrary cutoff period. And then finally, we talked about the average accounting return, which is a worse technique because it relies on the accounting profit, and it's relative to the book value, and similar to return on assets measure. Take the investment if the average accounting return exceeds some specified return level, and it has some serious problems and should not be used. Now, as a matter of fact, which methods do companies actually use? Researchers surveyed CFOs about what methods they use to evaluate capital investment projects. One interesting finding was that many companies use more than one of the approaches we have covered in this chapter. So the most popular approaches by far were IRR and NPV. This was used by 76 and 75% of the CFOs responding to the survey. So these techniques enjoy wider use in large firms, and with the payback approach more common in smaller firms or startup companies. So if you talk about a startup company, you are looking more into getting back your initial investment which you have done to start the business. Okay. So you prefer a payback approach. But if we talk about uh, companies which are having sophisticated projects to consider and which is irreversible decisions, they rely on NPV and IRR. So now let's take the quick quiz uh, and submit me the solutions for this. So you have to consider an investment that cost $100,000 and has a cash inflow of $25,000 every year for 5 years. The required return is 9% and required payback is 4 years. So you need to do what is the payback period, the discounted payback period. You use that cumulative discounted cash flow table which we have done in the Excel sheet, right? And you can use the NPV and IRR using the financial calculator. Okay, please show me the steps which you are using for the financial calculator. Okay, and then summarize your discussion which project you are going to accept based on each of these decision criteria. Okay, so then finally give me what decision rule should be the primary decision method and when is the IRR rule unreliable. So that's it from my side on this chapter. Thank you and have a nice time understanding the investment criteria. These are very crucial and important for you as a finance student. Okay, so if you have any questions, please don't hesitate to contact me on WhatsApp. Okay, so we will have a quiz on this. So till then, take care and stay safe, stay home.